I've figured out where to find out information about securities, but what kind of securities can I actually buy? Well, you have a few choices. You can buy an individual security. That can be a single stock or a bond. The word security is often used interchangeably for the name stock or bond. So when you hear them on TV talking about securities, it just means stocks or bonds, generally speaking. You could also buy a mutual fund. That is a group of stocks or bonds that are managed by a money manager. The mutual funds are regulated to protect retail investors. Retail means normal people, not qualified investors. And the money manager is paid a fee to pick and select those stocks for you. You can also buy an ETF or an exchange-traded fund. This is a basket of stocks or bonds, sometimes very specialized. For example, a basket of tech stocks, a basket of European stocks, etc. And that basket is fixed. It's not managed actively by a manager, so an ETF is often a way to buy a certain type of security without paying a high fee. You can also, if you like real estate, buy a real estate investment trust, REIT, which will tend to hold, for example, office buildings or warehouses or other types of commercial real estate. So you can bet on one company by buying a single stock, or you can bet on many companies through one security, which would be a mutual fund or an ETF. Now, people often ask me, why on earth do the markets go up and down so much? Actually, it's pretty simple. The stock and bond markets are based on what investors think about the future. If they are optimistic and they feel good, they think that the prices in the future will be higher than they are today. So they start to buy because they think the securities will be more expensive if they wait. They will sell safer securities like bonds, and they'll go buy riskier securities like stocks. Now, if they are pessimistic, there's some sort of bad news in the market. They think that prices in the future will be lower than they are today and stocks will be worth less or bonds will be worth less. And so what do? They start selling the risky assets like stock and buying the bonds. So the markets swing all the time, optimism to pessimism. So is the glass half empty or is the glass half full? You know what? Nobody knows. Some investors will interpret some facts as positive, and some will take that same set of facts and interpret them as negative. That's what makes the market. It also depends on your time horizon. So tech stocks have gone up over the last 10 years much faster than other types of stocks. And why is that? Because over the last 10 years, more and more people are using technology. Remember, the internet really only got going in the year 2000, so it's only been around for about 18 years. When people are nervous, tech stocks will go down because they look like they're about the future and maybe they're a little bit more risky. But if you're willing to have that long time horizon, you've made much more money staying with tech stocks. So the S&P 500 over the last 10 years, from July 2008 to July 2018, was up 10.49%, whereas the S&P tech stocks were up 15% per year annualized over that period. By the way, what do I mean by annualized? Well, it's a way to compare two different types of returns. So if you take the beginning date, July 2008, and you draw a straight line out to July 2018, and you were to create and calculate the average return that would get you from one point to the other, that's your smooth line annualized return. So stocks are fantastic if you have a long time horizon. But if you have a short time horizon, stocks can be very risky. So not too long ago, in 2008, there was a huge stock market crash. The stocks went down 34% from September 29th, 2008 to December 31st, 2008. So in 2 months, they went down 34%. In total, the stock market went down over 50% before it recovered. You can read about the crash here. Now, if you needed your money in fall 2008, you were in trouble. But if you waited, the market started to recover by July 2009. So the lesson learned is the stock market can be risky if you have a short time horizon. Don't put money into stocks that you need to get back right away.